Two-pronged question. The first one is general. How ugly does it get? How scary is it?
Scary. Well, happy Halloween.
Happy Halloween.
It can be scary. And so the good news is, GDP's looking just fine, 4.9% last quarter, probably about 2% this quarter. We'll get employment this Friday. Last month it was 336,000 jobs. We're expecting around 200,000 jobs. And so the Fed today, we're going to hear that they're on hold. And so all that is not so scary. But when I think about what really concerns us in the marketplace, and it is a bit scary, and the scariest we've seen this in kind of recent memory or in our lifetimes perhaps, is a war on two continents. That's scary. And the geopolitical problems that Western Europe and the US are facing that we haven't faced since the Cold War, that's scary. And so talking about markets, because that's really the question, it's really those that are highly levered, that don't really have liquidity, that should be most scared right now. And it starts with CRE, so commercial real estate. And I was just looking at last week's data where, the commercial real estate market can be encompassed, if you want to look at maybe the debt side of the equation, by the $1 trillion of CMBS securities. And the rating agencies, Moody's, S&P, and Fitch, the three of them downgraded on a ratio of 5 to 1, 5 downgrades for every upgrade, the CMBS tranches that they downgraded. That's really scary because you have this $1 trillion wall of maturity and a lot of value that's been crushed. And so if I'm a CRE owner-operator, I have to really focus on that. And for lenders, defend the fort. And for new loans, really high rates. The second thing to focus on, I think, is the corporate sector. The corporate sector isn't quite as stressed as commercial real estate. But when you look at high yield and loans, the highly levered companies, their downgrades are running 2 to 1. And the next quarter, fourth quarter and first quarter of next year, we expect the default rates to really start to spike upwards. And so we can see that doubling in the next 6 months. And the third element of that is the consumer.
He's saying all the answers, Guy.
And so the consumers are really, the consumer's really stressed right now, particularly the more leveraged ones, the subprime consumers.
Okay, I've got a cauldron of things that you're now putting all of this into, so I'm going to kind of fish around in the cauldron and figure out what we need to focus on. Let's talk about going concern. You talk about what's happening in the corporate sector, more at the stress end of the environment. When does that going concern issue really start to bite? Is it in Q4 or is it Q1, Q2, Q3 next year?
There's a great deal of the companies in the high-yield leveraged loan market that, given EBITDA, is using all of its EBITDA to service its debt, in fact, having to dip into their cash balances in order to service debt. And the question is, how many quarters do they have left of cash to be able to service these higher rates? And so we're going to see, come next April, when these audits are coming out, whether you have a going concern issue for some of these companies. And to get ahead of that, a lot of companies are going to be in the marketplace borrowing, and a lot of companies are going to try to, do what they can do, sell whatever they can sell, cut expenses, but that's a certain cohort of the high-yield market. I think, generally speaking, 90% of the companies in this sector are just fine. You want to enjoy those higher coupons. But for the 5 to 10% of the companies that are really stressed, they're burning cash, it's a real concern, and you'll have a going concern. And for those companies, that's where you'll really see default rates start to spike.
Well, that's such an interesting point, because if you take a look at, say, the forward equity, for example, I mean, it's up a little bit today, but man, that chart is ugly. But then it just gets upgraded to investment grade from high yield.
Yeah, so Ford we've been buying Ford, great company, but you listen to the UAW's negotiations of 25% increases, and Fain negotiated a pretty good package from the big three, and I think he, joking around, said to the UAW that I think we squeezed all the profits, all the earnings out of the big three here to negotiate this package. And so what you see is the equity's down 33% since the summer, despite being up today. It's down 20% year over year. Meanwhile, the high coupon bonds are up 10% year over year, and that's what we've been buying. And you have $40 billion of this debt that was junk that just got upgraded just in the last 24 hours to investment grade. So Ford's a credit, and it speaks to a lot of what we're seeing in the equity markets versus debt markets, where the credit is a much better investment than the equity risk. And if you look at like the S&P 500, 900 days ago, it's unchanged versus today. The Russell 2000 versus 1,400 days ago, unchanged versus today. Meanwhile, there's really good returns to be made in credit. 8, 10, and 12% coupons and cash flow.
Bruce.
Yes, Guy.
Do you think, though, that the Treasuries are going to... The benchmark here is the Treasury market, right? Do you think 5% is a reasonable number? Could we get to 6? Could we get to 7? People are talking about those kinds of figures. We're going to get the refunding operation very, very soon. But you've got a situation where government spend looks like it's not coming down anytime soon. In fact, if we see automatic stabilizers, et cetera, kicking in, it could get even worse. Isn't there a danger that yields go significantly higher from here, that you could get 6, 7% in the Treasury market? And I'm wondering where that leaves your credit market.
You know, we've been telling our clients, and I've been telling a lot of folks, that inside of 5% on 10-year notes, inside of that rate, 4%, 3%, 2%, that we'd be short. We recommend you're short your benchmark. At 5%, I would be neutral. Behind 5%, I'd be a staged-in buyer. Do I think Jamie Dimon's right and we're getting the 7% 10-year notes? No, I don't think we get there. I think he said that for emphasis, that rates are going to be higher for longer and have to move higher given these deficits, and to alarm everybody as to the staggering level of deficits. So, look, we're getting the quarterly funding today. 3s, 10s, and 30s will be announced, and we'll see where we come out. But over the next 6 months, we'll probably have to issue about $1.6 trillion in treasuries. That's only in 6 months, just like we did in the last 6 months. So when you talk about these $2 trillion deficits, and it used to be for years and years a $1 trillion deficit, all of a sudden it's a $2 trillion deficit.
Yeah, and interest payments don't help.
And the interest payments don't help, and the government's spending more and more, and they're not controlling what they're spending. And, you know, the government really needs to go on a diet. And what they need is a massive dose of Ozempic. They need to tighten that belt. Stop spending as much as they're spending, because they're leaving it for the next generation. And while you and I might be thinking about this quarter or next quarter, you know, rates being higher, but it's not a credit story for the government. Over the long run, we're leaving this big problem for the next generation.
So this sounds like I don't want to take duration risk, because the government's definitely not going to be taking Ozempic.
Well, I think behind 5%, you can start to, you know, be neutral your benchmark, be neutral your benchmark of duration. But what I would say is my preference is cash, but cash is only 1 day, and it can go away the next day. And so you want to lock yourself in maybe to something a little higher yielding, and there is where we like floating rate debt. And, you know, 5-year, 7-year notes that have these higher floating rates, and that's our preference, is to be short duration, not be afraid of duration when you're behind 5%, but be short duration and own a bit of duration. And so if we can own duration and lock it a 10% rate for 5 years or 7 years, we want to do that. And that's a really good investment. So we kind of like longer duration that's cheaper than 5% in terms of the base rate, as long as you're getting that 10, 12% on, you know, on the bonds that you're buying. And on the floating rate side, not taking the duration risk and avoiding those risks that are going to lead you down the default, because there's going to be a big cycle for defaults and restructuring debt. But what you want to do on the performing side is stick with, you know, your safer floating rate leveraged loans.
Can I just talk to you about vintages and just kind of figure out exactly, a lot of people are moving into the private space right now, Bruce. Do you only want to buy private equity, private credit vintages that happened after the rates reset? If you bought anything before, aren't you ultimately going to end up being in trouble? So the only vintages you want to buy are after the reset.
Well, I think the vintages of today are going to serve you very well, because you can underwrite to this higher rate environment and enjoy the higher rates as well. And I think that rings true of credit as well as private equity. Now, I think credit is getting paid a much higher rate of return relative to private equity, relative to history, and relative to risk, most importantly. So we're very favorably inclined to be in private credit, and I think private equity investors probably have to look at slightly lower multiples and slightly lower IRRs. As to your question, as it relates to vintage, you know, because there are a lot of evergreen structures that are out there, and a lot of money was spent, and the bubble period was really Q2 of 20 to Q2 of 2022. And so for that two-year period of time, if there are a lot of investments that were made during that period of time, I just think your IRRs will be significantly lower than what was originally underwritten or what was in expectations.
Has the market re-rated for that at all yet? Or when does that moment happen?
It's not that it hasn't re-rated. I think people are starting to get a handle on this. I don't think that you'll see the realizations of what this means for a few years out because these are long-term structures. But certainly if you're in a liquid structure, in an evergreen structure that was that vintage, you might want to think about moving to a more current vintage. If you can seize that liquidity and deploy in the more current vintage. I think that would be a smart thing to do if you have liquidity. But most of these structures are locked up where there's an investment period, there's a harvest period, and so you're in that investment, and you'll just see your 3 multiple be a 2 or a 2 multiple be a 1. Your 15% IRR maybe be an 8 IRR or 10 IRR. You'll just see lower returns and slightly lower multiples for that specific vintage, and and I think what's important for most institutions is you don't try to pick your vintages. You just keep on re-upping for the next vintage, the next vintage, and they'll all average out. And alts are the way to go. And I think that whether it's democratizing for the retail investors in high net worth or the institutional allocations, alts have served your allocation model quite well over a very long period of time.
Bruce, are these resources going to protect it? A lot of people got very rich as a result of low interest rates. You saw huge asset price appreciation. We're now going into a world for higher for longer. QT's tightening everything up. The world is changing. We are going to have to adjust. How should people that have done very well in the prior period protect their assets in this next period? How should they be thinking about it? If you're in the wealth management business, are you now in the wealth protection business in reality, or do you think you are going to be able to make a decent rate of return commensurate with the prior period in terms of asset appreciation?
I think it's an adjustment of a portfolio. I think on the margin, moving dollars away. You don't want to trade equities per se, but if you've been over-allocated equities, if you have a year like this where you've been well-positioned and the S&P's up and NASDAQ's up, rebalancing at the end of the year because now you have extra dollars that you've made as a part of that portfolio and rebalancing to credit and fixed income, I think will serve you well. And so I think it's more of a balanced portfolio. If you look at a 60-40 model, for instance, where you're 60% equities and 40% in fixed income, that hasn't served you well. You're down over the last 2 years on that model, 60-40. And so what is the right model? Is it 60-30-10? No, I think it's more like, I don't know, 30-20-40 or 40-20-40? Because alts have so much outperformed fixed income and equities. I think everyone's got it wrong. The question is, do you have the liquidity for that? So when you look at the big endowments, you look at Yale University and these big university endowments, they're 50, 60, 70% alts.
Right, that's going to be something too.
So I think moving more capital away from equities to the credit side right now is the thing to do.